All right, people. Now we'll be solving solvency ratios. According to syllabus, we have 5 solvency ratios. First is debt equity ratio, which is debt divided by equity. And then we have debt to capital employed ratio, which is debt divided by debt plus equity. Then we have proprietary ratio, which is equity divided by debt plus equity. Then we have total assets to debt ratio, which is total assets divided by debt. And then we have interest coverage ratio, which is profit before interest and tax divided by interest on long-term debts. All right. We'll be playing with these ratios. I've divided them as much as possible. I've divided them based on specific ratios. Unlike in liquidity ratios, we had questions from liquid ratio and current ratio mixed up, right? So I've divided them according to each ratio in the solvency ratios. Some of them might have got mixed up. And in the beginning, we have all these general solvency ratios. Okay. All right, let's start. Which of the following ratios is not a solvency ratio? Current ratio is not a solvency ratio. It is a liquidity ratio. The best definition of capital employed in calculating the rate of return on investment. What is capital employed? It is shareholders' funds plus long-term liabilities or long-term debts. So in shareholders' funds, so let's put it, let's prepare a balance sheet to solve this. We have non-current assets, current liabilities, shareholders' funds, and long-term liabilities. The total assets minus current liabilities will leave us with shareholders' funds plus long-term liabilities. So this can also be written as total asset minus current liability is equal to shareholders' funds plus long-term liability. If you want to go back one more step, then it is total assets is equal to shareholders' funds plus current liability plus long-term liability, and then current liability comes here. Understood. Total assets can be divided as non-current assets plus current asset minus current liability is equal to shareholders' funds plus long-term liability, which is capital employed. This can be, if you put these two in brackets, and we'll get non-current asset plus working capital is equal to capital employed. So working capital plus non-current assets is the definition of capital employed. This from the balance sheet. Test of solvency of a business undertaking means its ability to meet interest costs, its ability to meet the long-term liabilities as and when they become due, its ability to pay dividend to shareholders. All of the above. So solvent means you should be able to meet your liabilities. That is the point, right? So all of them. The immediate solvency ratio is quick ratio is current ratio is current ratio, and quick ratio is liquidity ratio, current ratio is liquidity ratio. Stock turnover, immediate solvency. Kind of question is funny. Immediate solvency in the sense as they become due. If you have to justify the answer, so the ability of the firm to pay the debt as and when it is due is quick ratio. So kind of not a great question, I would say. Which ratio is not part of solvency ratio? Current ratio. Question repeated. Question number 5. Question number 6. The data of Bemisal Limited given as follows. In fixed assets, accumulated depreciation, trade investments, current asset, current liabilities, find capital employed. When they give you questions like this, just prepare the balance sheet. It'll be easy. Given fixed asset and accumulated depreciation. So I'll reduce fixed asset minus accumulated depreciation is 10 lakh. Trade investment is 1 lakh. Current asset is 4.4 lakhs. Current liability is 3.4 lakhs. Capital employed is not given. So this minus this will give this. So 15.4 minus 3.4 will give 12 lakhs. So the answer for this question will be 12 lakhs. Narayan Limited shows its current asset, non-current asset of 52 lakhs, current assets of 18 lakhs. Shareholders' funds are 43 lakhs. Find out the total debts of Narayan Limited. Non-current assets of 52 lakhs. Current assets of 18 lakhs. Shareholders' funds of 43 lakhs. They want you to find out the total debts. That is total debts and long-term debts plus current liability, how much. So this figure is missing. 52 plus 8, 60 plus 70 lakhs minus 43 lakhs. No, 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 no. 70 lakhs minus 43. So 30 minus 3. 27 lakhs is the correct answer. Which of the following accounting ratios comes under solvency ratio? Fixed asset turnover ratio, asset test ratio, working capital turnover ratio. Total asset to debt ratio is a solvency ratio. Understood? All right. In a concern, total asset to debt ratio is 3:1. Total assets are 12 lakh and current liabilities are 80,000. Equity is, wow. Nice question. Total assets divided by long-term liability is equal to total asset to debt ratio. 3:1. Total asset is 12 lakhs divided by long-term liability is equal to 3/1. So long-term liability is equal to 12 lakhs divided by 3, which is equal to 4 lakhs. Now let's prepare the balance sheet. Total assets are 12 lakhs. The whole thing put together. So this side also should be equal to 12 lakhs. And we have equity, we don't know. Current liability, we have 80,000. Long-term liability, we have 4 lakhs. So 4 lakh 80,000. 12 lakhs minus 4.8 lakhs will give you 7.2 lakhs. That is your total asset to debt ratio. Calculate working capital turnover ratio from the following information. Nice. Working capital turnover ratio is not part of solvency ratio, so I don't know why I put it here. Anyway, as the question is there, let's just solve it. Revenue from operation divided by working capital. If revenue from operation is not given, then cost of revenue from operation. So revenue from operation is given 12 lakhs. Working capital we need to find out. They given current asset. Working capital is current asset minus current liabilities. They're given current asset, but current liabilities is not given. Instead, they're given a lot of numbers. Let's put them all in a balance sheet and see if we can get the answer. Non-current liabilities are 3 lakhs. Shareholders' funds are 4 lakhs. Total assets are 8 lakhs. So this side will also be 8 lakhs. 8 lakhs plus 7 lakh is capital employed. So 1 lakh will be current liability. Current asset 3 lakh. And current liability 1 lakh. So working capital will be 2 lakh. 12 lakh is the revenue from operation divided by working capital of 2 lakh will give us 6 times as the working capital turnover ratio. All right, children, moving forward. The debt equity. Now we're going to be jumping from all the basic solvency questions to the debt equity ratio related questions. 1 or 2 questions might be from here and there, but most of them are debt equity related questions. Debt equity ratio for company is 1:2. Purchase of fixed asset for 5 lakh on long-term deferred payment basis. What will happen to the debt equity ratio? Debt equity ratio is debt divided by equity. If you purchase fixed asset, 2 things happen. Fixed asset goes up and you purchased on a long-term deferred payment basis, which means your long-term liabilities go up. Long-term liabilities are part of debt. So this will go up. When numerator increases, the ratio increases. So the answer for this question is A increases. All right, 12th question. Capital employed can be calculated by debt plus equity. That's it, debt plus equity. 13th question. Which of the following will reduce debt equity ratio? Payment of bills payable on maturity. Bills payable is a current liability. When you pay current liability, it does not affect debt equity ratio in any way whatsoever. So A is wrong. Conversion of debentures into equity shares. You're converting debentures into equity shares, what happens? Okay, good, good. Nice, yeah. So debt equity ratio is debt divided by equity. When you're converting equity shares and debentures into equity shares, debt will reduce, equity shares will increase, which means the numerator is reducing and denominator is increasing, and that means this will reduce the ratio. So this has to be the right answer. And you also have issue of bonus shares. When you issue bonus shares, equity will increase, debt remains constant. No, no, no. This is a nice question. From where can you issue bonus shares? From reserves and surplus. So the shareholders' funds remains constant when you issue bonus shares. See, bonus shares can be issued from reserves and surplus. Whatever you have stored, out of that only you can issue bonus shares. So put together, they are equity. So this reserves and surplus changes to equity share capital. That's all. So this total number remains constant. So this cannot be the answer. This is the answer. Well done, children. Nice. Debt equity ratio, debt divided by equity. Which of the following transaction will increase the debt equity ratio? Which is 1:2. Okay. Issue of shares for cash. When you issue shares for cash, what happens? Equity will increase. So obviously, will decrease the ratio. Redemption of preference shares, equity will decrease, will increase. Redemption of debentures, debentures will decrease, that will decrease. Conversion of debentures into shares, debentures will decrease, shares will increase. So it will again decrease. Only when you redeem preference shares, equity reduces, and therefore denominator reduces. Now the ratio will increase, and the answer here is redemption of preference shares. All right, 16th question. Debt equity ratio expresses the relationship between long-term debt and equity shareholders fund. Not equity shareholders fund. Entire shareholders funds. Equity, preference share capital, everything. Reserves and surplus, everything. Okay. All right, children. The debt equity ratio of Kanak Limited is 1:2. Now the company decides to purchase machinery on long-term deferral. How will the ratio? Already solved in this video itself. So we'll want to solve it again. Total assets 8,10,000, total liabilities 2,60,000. Current liabilities 40,000. Debt equity ratios, total liabilities 2,60,000 minus current liability will give you long-term liability. 2,20,000 is your long-term liability. Debt equity ratio is 2,20,000 divided by equity. Now equity you need to find out. Total assets are 8,10,000. So total liabilities will also be 8,10,000. Shareholders funds only we don't know. Long-term liability we found out to be 2.2 and current liability we found out to be 2.6. 40,000. So 8,10,000 minus 2,60,000 will give me the equity. 7, 11, 5, 5,50,000. So 5,50,000 is equity. So this will go 2 times and this will go 5 times. 2 by 5 is what? 0.4. So answer is B. B is the correct answer, my dear children. 19th question. While calculating debt equity ratio, which of the following item will not be included in debt? Debentures redeemed within 24 months. Debentures to be redeemed within 28 months. Debentures to be redeemed within 12 months is actually current liability. Current the maturities of long term, current maturities of long term debt. So the current liability. So Debentures redeemed within 12 months will not be included as long-term liability, and therefore that will not be included in the calculation of debt equity ratio. Which of the following will decrease the debt equity ratio? Oh, which of the following will decrease debt equity ratio? Purchase of fixed asset by taking a long-term loan. When you purchase a fixed asset, asset increases, you're not bothered about it, but you're taking a long-term loan, so debt increases. Debt is the numerator of debt equity ratio. Debt increases means obviously ratio increases, but they are asking about ratios, actions that will decrease the ratio. So that is not the correct answer. Purchase of extra asset by issuing shares for consideration. When you purchase assets and issue shares as consideration, fixed asset increases as well as equity will increase. So debt divided by equity, the denominator increases mean the ratio will decrease, and therefore B for boy is the correct answer. Understood, children? All right. All right, children, we completed 20 questions. We have 21 to I think we can do 25 questions. Last 25 we'll do it in the next video. 20 questions completed. 21, 22, 23, 24, 25. Looks like easy. The 21st is a assertion reason based question. If debt equity ratio is 1:2, it is considered to be safe. From security point of view, the capital structure with less debt and more equity is considered favorable. It's true. The optimum level, the maximum level you can have for debt equity is 2:1. But then when the debt is less than equity, it's good for the company because the company can always pay the third party debtors, third party liabilities. So both A and R are correct, and R is a correct explanation of A. I started using accent, I don't know for what. Anyway. Debt equity ratio is long-term debts divided by shareholders' funds. A. 23. Debt equity ratio of a company is 1:2, which of the following factors will increase it? Issue of new shares for cash will increase the denominator of debt equity ratio and therefore will decrease the ratio itself. Redemption of debentures will reduce the denominator of debentures, debt equity ratio, and therefore will decrease the ratio. Issue of debentures for cash will increase the numerator because more debentures are coming in, more debt is coming in. Therefore, this will increase the ratio. Goods purchased on credit will not touch debt equity ratio based, entirely liquidity based. So 23, the answer is C. 24, satisfactory ratio between long-term and shareholders fund 2:1. The optimum ratio is 2:1. 25. Nice. Paid up capital 6% debentures. DRR means debenture redemption reserve is part of debenture redemption reserve, and it is part of reserves equity. So the total equity of the company is 6 lakh plus 2 lakh, 8 lakh. And the total debt of the company is 3 lakh plus 1 lakh, 4 lakh. So debt equity ratio is 4 lakh divided by 8 lakh. Debt divided by equity 1/2, which is 0.5:1. We'll solve 25 questions, my dear children. Remaining 25 we'll do it in the next video. People, take care, have fun. Bye. If you're not subscribed, please subscribe and share it with your friends, man. Bye.